Hello guys, a very good afternoon. It's 2 p.m. Indian time sharp, and that would mean that we are starting today's class, right? And as you know, this is the schedule of the class. Okay, 2 to 2:10, I ask you questions, right? And 2:10 onwards, I will start. And where will I ask you questions from? I will ask you questions from the first class. These were the 20 topics that we looked at in the first class. Okay. So, Deepika, how are you? Are you there? Am I audible? Okay, Deepika, can you tell me? And please, unless you don't have like a mic or something, again, please make sure you have a mic. But unless there is some genuine reason, try to unmute and speak, right? Uh, Again, those of you who don't have the link, I don't know, I've just got one message from one of you asking for the link. I don't know why people are still asking for links. Just give me a second. Okay. Deepika, can you tell me a little about agency problem? What is agency problem? Can I know what agency problem is? Agency problem is when director might not work for the company benefit but work for themselves. Very good, Deepika, that's absolutely right. Next would be Manu. Manu, I did not see you in the last class. This is a new name I'm seeing. Manu, did you watch the previous recording?
Yes, sir.
Very okay. So Manu, can you tell me what is value for money? What's value for money? You don't remember? Okay, guys, see, our objective is not only to give you classes and go, saying, oh, it's free classes, so if you attend, you attend. If you don't attend, don't attend. If you study, you study. Don't study, don't study. No, we want you to pass with very good marks. So that's why every day, without fail, 2 to 2:10, I'll ask you questions. And every Friday, there will be a test, mandatory test. Without writing that test, you'll not be able to access the LMS further. So all those things we have kept to make your life, I don't know if you will consider it as easier, but please make sure you study. How to access previous class recordings. Again, Anjana, this has been shared in the group, but any questions of this sort, put them in the group and we will immediately answer them for you. Right? I have a team exclusively sitting and monitoring the group and ensuring that everything is shared with you as and when you. So we have the LMS access, our learning management system, where you can access all the previous recordings, where we will upload all the tests and you will get your marks also immediately. Kitu, as I mentioned, these are the class timings. 2 to 2:10 questions, 2:10 onwards I start. Only admins can chat. Okay, I will have that checked. Even otherwise, we have a hotline number. You can drop a WhatsApp message on that hotline number. We will immediately respond. Do you have that hotline number, Anjana? Probably you joined late.
No, sir, I don't have the hotline.
Okay. So I will share the access, how to access the material. I will share it with you. Okay. Anyway, moving on. Arisha, can you tell me who a stakeholder is?
Am I audible?
Yes, you're audible.
So a stakeholder is somebody who has like interest in the company.
Somebody who has an interest in the company.
Yeah.
Yes, anybody who has an interest in the organization is a stakeholder. Very good, perfect. Um, Again, somebody's asked me a question. Any exclusive chat where we can drop our queries? Yes, there is a hotline number. Again, I will share it in all the groups today about the hotline number. In fact, I'll ask my team to just come and join me. Again, guys, we're taking all these efforts for you. So you make sure that you are properly utilizing this. Okay, I'll have him drop the hotline number again. Babu, what I want you to do is many of these people still don't have access to the hotline. So in all the groups, FM, PM, TAG, AA, FR, all the groups, drop the hotline number. Okay, guys, I've informed my team also. So the hotline number will be dropped in the group in the next few minutes. Okay, next is Osama. Osama, can you tell me what is Kaushif Niaz is also a new name I'm seeing. What is depreciation? Kaushif, have you watched the previous recording? No, please make sure you do. Right? This is the second class, not the first class, and I don't want anybody to be lost. So as soon as this class is over, sharp 5 o'clock, I'll end the class because we follow very strict rules. I've asked my team to, in our office group, mention that if we have to question me. These timings. So I'll end sharp at 5 o'clock. So after 5, please make sure that you are accessing the LMS and watching all the recordings. Depreciation is an accounting standard which tells us that we ought to expense out the non-current assets over the useful life. So, no, Osama, this will be wrong. Depreciation is not an accounting standard as such. IS 16 is an accounting standard that talks about, and again, I don't know why we're talking about, I mean, this isn't even FR. Okay. Yeah. So IS 16 talks about what? It talks about PPE. Yeah, it talks about PPE, how to deal, how to recognize. Now I feel like I'm in FR class, which is tomorrow. How to recognize PPE, how to measure PPE. That is what IAS 16 helps. And yes, there is a mention of depreciation there also. But depreciation is when there is a drop in the value of an asset due to wear and tear. This drop in the value of an asset due to wear and tear is depreciation. Manu, depreciation is the allocation of an asset's cost over its useful life. Reduction in the value of asset. Jigyasa, yes, that is absolutely right. Is an expense charged. Yes, get to that right. Depreciation is an expense charge. But depreciation is basically drop in the value of an asset due to wear and tear. So when you use something, say you use a mobile, that mobile will get worn out as and when you use it. Like for example, my shoe right now, the shoe I'm using, the shoe I'm wearing right now, the more I'm wearing it, no, the more it's kind of stretching and getting worn out. So this value in the shoe is dropping. This drop in the value is depreciation. Attention students, I'm just reading out the message. Attention students, got doubts or need assistance? We're here to support you every step of the way. WhatsApp us at the number is there. Remember, it's Indian number, so +91 needs to be put if you are outside of India. Whether it's about your course, class schedule, LMS access, or any other queries, our support team is just a message away. We strive to ensure a smooth learning experience for you, so don't hesitate to reach out. Let's make this journey productive and hassle free. Best regards, in Chartered Academy. Yes. So that Kittu should answer your question. So the number is being shared. In all FM, PM, tax, FR, AA groups. It will be shared now. Okay, good. Yes, of course, Arisha, you can.
Like the formula for what? Normally we have like in FR we have studied it's like capital employed divided by capital employed, but here it's like initial capital cost, or we go for average like capital investment. So I have a question like formulas अलग-अलग क्यों है हर जगह पे?
Formulas अलग-अलग क्यों हैं? Why are the formulas different everywhere? That is the translation for those of you who don't understand. Okay, formulas, again, from what I have understood, you are asking कि यहाँ पे formula is profit before interest and tax divided by initial capital. Which is the other formula that you're referring to?
Like the formula we have in FI, PBIT over capital employed.
PBIT divided by capital employed. So see, ultimately, formulas अलग इसलिए हैं because what happens is, see, for example, in FM, you're saying, this is FM, right? So in somewhere else, you're saying that the formula is PBIT divided by capital employed. And here you're saying that, oh, here it is average annual profits, annual PBIT divided by capital employed. So you're asking, why is this different?
No, I'm not asking this. I'm asking capital employed की जगह पे it's average capital investment or initial capital investment. और फाइल में तो होता था ना कि हम capital employed को खुद से calculate करते थे using like non-current assets, loans and all this stuff.
Okay. So again, your question is, why do I have two formulas? One is average capital, one is initial capital. Have I understood correct? Yes.
Yes, I've got it.
So the answer to that is, again, first of all, profit before interest and tax, average annual profit before interest and tax. Here, what happens is, it depends. Like if there is a certain project that has, I'm just explaining this part, okay? If there's a certain project where the cash flows are over a span of 5 years, 10 years, obviously there is no one specific number. There's no one profit figure. There are 4, 5 profit figures. So we take the average of that. So it's not like, again, I know this is probably not exactly what you're asking, but the reason we have average is when you have multiple years where you have cash coming in, which is very likely the case. Now, coming to why do we have two formulas? One is average annual profits before interest and tax divided by initial capital. And the other one is average annual profits divided by, before interest and tax divided by average capital investment. Now, again, in order to do appraisal itself, right, you basically look at the capital, the very fact that either the initial investment you're looking at, capital, the initial capital is say 400,000. Okay, this is how much you initially invested. Either you can look at that, the actual amount that you put in. This is the actual amount you put in, which is the most commonly used formula. Again, you can see this note, just read it. It says in the exam, you should use the initial capital cost unless you are told otherwise. ROCE calculation based on average capital investment is the most commonly asked for in this exam. This will be made clear in the question. So again, they've told you that you will use the initial capital cost method, but in the exam, they will tell you which method to use. So the question comes back. Why are there two formulas for ROCE where you either take initial capital cost, which is the first formula, which is most of the time you will use, or the average capital investment? What is the reason? Anybody has the answer to this?
maybe like we have many capital investments given, so we use average capital investment.
So here what happens is, the most obvious reason is sometimes your capital, initial capital, it will be maybe, okay, let me put an analogy to this. But you invest in a toy shop and you've totally invested 50,000 and that's it, right? Totally, you have invested 50,000 and that's the end of the story. So here you will obviously use the initial capital. But sometimes the capital itself, like in this case, we've purchased a plant item. So this is something, the value of which, because of depreciation, as we've seen, will change. So the capital itself is, the value itself is changing, right? Probably because the initial capital is 50,000, but later there is a change in it. When that happens also, okay, there is 45,000. So which figure are you taking? You take the average figure. So the idea is, when there is only one figure, it's easy. But when the capital value changes, or say there is further capital being injected into the business, so it's not just 50,000, right? There's more capital being injected. In that case, you might want to take an average, right? So again, which method to take, the question will tell you. Okay, Arisha, clear? Okay. Now, today it's 2:18. What are we going to do now is basically continue from where I had stopped in the last class, which is test your understanding 2 of chapter 2. And today we will finish chapter 2 and move to chapter 3. And again, today's date is 24th of March. Okay, and I'm going to introduce to you accounting profits and cash flows. And again, I'll introduce to you with the help of an analogy. So 24th March 2025. First thing we're looking at is accounting profits and cash flows. What does the textbook say? In capital investment appraisal, it is more appropriate to evaluate future cash flows. Sorry, evaluate future cash flows. What? It is more appropriate to evaluate future cash flows than accounting profits because blah, blah, blah. Reasons are given. So cash flows are a better measure of the suitability of cash investment. Now, I don't know how much you people would rate your understanding out of 5 for what I have just read. But again, you have joined here for an explanation, right? Not just reading. So I will explain this to you with the help of an example, right? And I will use your example to explain this. You people, there are 15 of you present who have joined us for the free batch, any one skill level paper. Now, yes, having you people on board is something that we celebrate. We're very happy to have you on board. In fact, I will be happy if there are 200 present online. FM, I think the strength is about 50 to 16. Most of them are watching the recordings, but I will be happy to have all of them live. But what I'm trying to say is, having you people is something that we celebrate. Having you people is something that we really enjoy, right? So I would like to use this opportunity to show my gratitude to be here. But for example, I have an electricity bill that needs to be paid. Right? I have to pay an electricity bill. You people are there. Yes, I am happy. It's a good thing. But this batch is a free batch. So although you are there, in order to pay my electricity bill, I need cash. So having students, let's assume that you are paying the fees, but you will pay the fees later. Having the students alone is not enough. We also need what? Again, having the students alone will not help us pay the bills. Maybe 100 of them have joined, but they will all pay after 3 months because we have given them 3 months time to pay. Again, the problem is today I have to pay my electricity bill. So nobody will look at what profits we have. I'm sorry, but we cannot look at the profits because yes, I am having profits. I have 100 students. They all will pay money, but they have not. So how is my wallet right now? Even though I have 100 students, how is my wallet? Like this. So even though I have profits, I need cash to pay my bills. So profit is something that is good. Definitely you need it. But profit might not necessarily help us in paying our bill because maybe we are yet to receive the money, we are yet to receive it. So it is not profits that we will look at. In order to pay my electricity bill today, in fact, that guy has come, he's under the building. In order to pay my electricity bill today, I need cash, and therefore, although we need to look at what profits we have, it is the cash that helps us pay the bills. And if you have understood this, which I hope you have, the same story applies even to investments. Yes, you have profits, you are making money, very good. But I want to get a new office, which in reality, I'm getting a new office, right? In the last class, I had a couple of them attending offline. Today, they're absent. But the offline people will tell you that I'm actually getting a new office. So I have to make an investment, right? But profit, oh, what is profit? I mean, it's coming after 6 months. That is also profit. No? I've made the sale, I've enrolled the student, but it's coming after 6 months. That is also profit, but I cannot pay or I cannot invest using that. It's not a good measure to look at profit because profit might be high. I might have 100 crores, but this 100 crores will come after 6 months. So profit is not that much of a good measure when you see whether you are, when you see whether you can invest or not. You have to look at what is the actual cash that you have. That is what matters. I can give you another example so you understand this very, very clearly. But I have a piece of land. Okay. I have this piece of land. This is my land. Okay. And obviously, when I bought it, it was only 5 lakhs, but now it is 10 lakhs. So I have a profit sorry, okay, I bought it for 5 lakhs, now it is 12 lakhs. So I have a profit of 7 lakhs, but where is this 7 lakhs? Where is the cash? I don't have it. How is my wallet looking like? Even though I have a profit, my wallet is still empty. So if I want a new office, I don't have money. Again, remember, it is not the profits that will help you decide actually. It is not the profits that will help you understand whether you have investment appetite, whether you have investment strength or not. It is the cash. So profit cannot be spent. When I say profit cannot be spent, I mean this is money that you have earned. Yes, no doubt. Yes, it is something that I will celebrate, but maybe I don't have it yet to spend. You understand? So again, it is cash that is a better measure, better thing to look at to see whether I can invest or not. Right? And the thing with profit is very subjective. Profit is very subjective. This would depend on or will vary depending on the accounting method used, maybe. For example, somebody who uses straight line method of depreciation may have a higher or lower depreciation cost. And because the cost is higher, maybe profit will be lower. So depending on the accounting method used, profit figures may go up or down. But I cannot decide whether I should buy this new office based on that. What if it goes down? Then who will buy the office? Right? It is the hard cash that will actually be used to invest in my new office. Right? Not profit. Because profit, one guy will say profit is 10 lakhs, other guy will say it's only 8 lakhs. So how do I know? How do I know if I can invest or not? That is what the textbook says when it says that the profit measurement is very subjective. It will really depend on what method is used, how it is calculated. Right? So ultimately, it is the cash flows that will really matter and not the profits. At least in order to decide whether you can invest or not, and for investment appraisal, I still see people are still joining, guys. Randomly, if you join, you'll not understand what I'm saying. So please make sure that you're joining dot on time. Okay, this is the schedule that we follow. So 3:25 to 3:35, we will have a break. So I hope all of you are clear about why it is the cash flows. Again, I've explained it, but some people, I don't know, for some reason, they have a habit until and unless the faculty does not write, they don't write. They will sit and watch like it's a Netflix movie. They will be sitting and watching. I'll give 4 examples, 5 examples, still they'll be watching. So I don't know why there is this habit, at least in this part of the world. I've seen people are not used to, I mean, they just follow the school and college format. Nobody is writing lecture notes. Unless the teacher starts writing, then everybody takes their pen. So please don't follow that. You're doing ACCA and you have to take down lecture notes. Right? Anyway, just for your sake, I will just put it. It is cash that will actually be spent and used, not profits. Profits may be high, but we may not have received it yet, for example. So ultimately, it is cash that is spent, that is actually spent, and hence, cash is a better measure of investment appraisal. Better thing to look at is a better thing to look at while doing investment appraisal. Second point is, what is the second point? Cash, what cash you have is the cash you have. I know it sounds silly to say that. What cash you have is the cash you have. But profits are subjective and may vary depending on the accounting method, for example. So to actually look, surely it is cash that will actually tell you what you actually have in hand. That will tell you what you actually have in hand to spend. I can give you one more example to close this with a very happy ending. But I deal in shares also, right? I deal in the stock market. So I have quite a lot of interest, right? Say I buy a share for 55 rupees. You don't need to ask me, Nitesh. I will not say no. Imagine you ask me, sir, may I write this? And I say, no, you can't write this. We follow a rule that strictly you're not supposed to write down notes. You can write everything, what I say, what I write, everything is for you to write. Okay, but anyway, let me just continue my example. I buy a share for 55 rupees and I sell it for 59 rupees. And say I have 1000 shares. Each share I have made a profit of 4 rupees. So I have a daily profit of 4000 rupees. Okay, but I have a profit, yes, 4 rupees profit I have. But those guys with whom I deal, Geojit, for example, they haven't yet released that money. Or I still haven't received this 4 rupees. So if I want to invest in a machine, this 4 rupees is of no use to me because I haven't received it. If I want to invest in a machine, I have to open my wallet and see what do I have in my hand. And that is why, guys, it is cash that is the better measure. So I hope you are clear. Whenever you're, again, guys, don't study to pass the exam. You will definitely fail. You have to study to understand concepts and to actually get knowledge. Then you will pass. Passing is a byproduct of actually getting knowledge. So, whenever you're doing investment appraisal, whenever you want to decide, can I put in project A, can I put in project B, you have to look at cash, not profit, in order to decide. Okay, profits are subjective, yes, and it is ultimately cash that you will actually pay to your owners. Anyway, what we need to say is it is cash that will be looked at, right? The next thing we have to look at is relevant costs. And again, for all methods of investment appraisal, with the exception of ROCE, only relevant costs should be considered. These are future costs, incremental costs, blah, 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 blah. Relevant costs, there's a big box. The only cash flows that should be taken into consideration into capital investment are cash flows, blah, 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 headache. Okay, headache. So let's try to solve this headache, right? And make life easy for us. Okay. Imagine we are going on a trip. Where do we want to go on a trip? Vacation. Who can type? Whoever types the first, we will go to that destination. Where do we want to go on a trip? Fastest finger first. Manali, Goa. Okay. So we go to Manali now. Kittu is going to Japan. Kittu, but okay. First person, we'll go to Manali. Right. So we are all going to Manali. Okay. Nitesh is going to Oman. Okay. Kittu is going to Japan. Tell me one thing. You want to decide, Hunza? One second. Hunza Valley. Oh, okay, it's in Pakistan. Right. I just quickly Googled it so that I don't sound ignorant. But I'm honest that I Googled it. Hunza, yes. So Mariam is going to Hunza Valley. Okay. Kittu feels Manali is overrated. Kittu, you've been to Manali? Many times. Oh, okay. Fine. So anyway, we'll go to all the places. First we'll go to Manali, then we'll go to Goa, then we'll go to Japan, then we'll go to Oman, then we'll go to Hunza Valley. Of course, funded by you people. I'm just coming for free, right? So imagine we're going on a trip and you want to decide whether you are going or now when you decide whether you are going or not, let me just give me one second. So I have my small definition of relevant cost, which I wrote it down in my so that I'll give this example and come back. Right. So you want to decide whether you are going or not. Tell me one thing. If you go, we'll look at two scenarios. Scenario one, if you will pay for the flight, and the flight is 20,000 rupees. Okay. Scenario two, if you don't go, will you book the flight? No. So do you have to pay 20,000? So if you don't go, you will pay 0 rupees. Right? So if you go, you will have the cost. If you don't go, you will not have the cost. I'll give you one more small example, and then we can look at what relevant cost is. The next case is scenario one. See, you have already paid me for your hotel. Already paid for hotel. Already paid for the hotel. It's non-refundable. If you go, then also you have paid 15,000 for the hotel. And if you don't go, also, the money will not come back. Now, again, what is in blue is basically where, what is in blue is basically the cost is being affected by the decision that you are making. If you go, you will pay 20. If you don't go, no need to pay. This is a relevant cost. Why? Because depending on your decision, either the cost will be there, or the cost will not be there. Either the cost will be there or the cost will not be there. So this cost is relevant to us. This cost is relevant to us. This is a cost that is affected by the decision we have made. And that's why this cost is relevant to us. It is being affected. This cost is relevant to us. It matters to us. It matters to us. Our decision will have an effect because of this cost. But what is in green, you see that it's already paid. It's non-refundable. So now whether you go or you don't go, this cost is not affected. This is a cost that is not affected by the decision you are making. Whether you go or don't go, it doesn't matter. It's gone. And because it's gone, whether you go, you don't go, it's gone now. So, no matter what I decide, it's not like if I go, I will pay. If I don't go, I will not pay. Our decision will have no effect because of this cost. Why? Because no matter what I decide, this cost is gone. This money is gone. You decide to go, you decide not to go, this is gone. So our decision will not be affected because of this. So a relevant cost is that cost which, again, it's not clearly mentioned here, but a relevant cost is that cost which will be affected by the decision you have made. For example, now what the textbook is mentioning is just examples. A future cost is a relevant cost. Example, a future cost is a relevant cost. What do I mean by that? Again, you want to go for a movie, you have not paid ticket. You want to go for movie, but you haven't paid ticket. You will pay it in future. In future. So if you go for the movie, you will pay for the movie. I'm just editing in the flight place. Okay, because the budget was short. Somebody wanted to go to Japan, somebody wanted to go to Oman. We had budget problems, and then finally we are going for a movie. Now, this is something that definitely happens in my case, at least. You know, family and friends, they will make a plan to go to the moon first. And gradually, you know, there'll be changes. Finally, you go to the beach. So that is what has happened in our example also. We were going to Japan. Now we've decided to go for the movie. Somebody will have something, somebody will have some work, somebody will have some exam. Right? Kittu is able to relate. Right? So finally we are going for a movie. So if you go, it's a few you're paying the ticket in the future. You haven't paid it yet. So if you go, you will pay 180 rupees. Now in Chennai, I don't know about other places. I think other places in India are more expensive, but in Chennai, it's only 180 rupees. If you go, you will pay 180. If you go. If you don't go, 0 rupees. So this cost is a cost that is relevant to your decisions. It matters because it is affected. It moves based on your decision. And obviously, because of that, your decision itself will be affected because of this. Oh, if I go, I will pay 180 rupees. If I don't go, I will not pay anything. So your decision itself will be affected because of this cost. Maybe if you don't have money, you will not go. So this cost is a cost that you will incur in the future and therefore will be subject to your decision. That is, if you decide you will pay, if you decide to go, you will pay. If you decide not to go, you will not pay. So this cost is relevant. Okay. However, so a future cost is relevant to us because we will pay it now. We are supposed to pay it in the future, and obviously we haven't paid it yet. We are yet to decide. So a future cost is a cost which will be affected by the decision we make, and therefore is relevant to us. It matters to us. Your decision will have an effect because of this cost. If you go, you pay 180. If you don't go, no need to pay. But what about a sunk cost? A sunk cost is a cost. In both cases, I'm putting example in red so you are able to catch it. But in case of a cost that is not relevant, sunk cost is an example of a cost that is not relevant. What is sunk? What is sinking? If this is the ocean, this is the ocean. Sink means what? Sink means go down. It's gone. So sunk cost is a cost that is gone under the water. Right? It has sunk. The cost is all, it's not sinking, it has already sunk. It is gone under the water. So example of irrelevant cost is a sunk cost. Now you go for movie, you don't go for movie. The ticket is gone. Ticket amount is gone. So the cost is not affected by your decision here. If you go also, it's not like the money will come back. If you don't go also, it's not like the money will come back. So this is not affected by the decision you are making. So this is going to be irrelevant. It is gone. Now, no matter what you decide to do, it is gone. Whether you go, you don't go, it doesn't matter. Whether you go, you don't go, it doesn't matter. And your decision will no longer have an effect because of this, because no matter what you decide, that money does not matter anymore. It's gone. Right? So I've given you, explained to you what is a relevant cost and what is an irrelevant cost. An example of a relevant cost is a future cost, and an example of an irrelevant cost is a sunk cost. A sunk cost is a cost that has already been incurred, and because it is already incurred, it is no longer relevant to us. I can give you one final analogy to simplify this, but again, using the movie example, you want to go for a movie. Right? One friend hasn't watched it and will watch in the future. So you also haven't watched, and this friend also hasn't watched. He will watch in the future. So now you are happy because this guy also hasn't watched it. You might go and watch in the future. So what he says is relevant to you. He or she says is relevant to you. Because he will say, oh no, this week actually I have a test. Let's watch next week. So again, it's a future thing. So it's relevant to you. He says, no, next week we'll watch. So it's relevant. He says, I have a test. It's relevant to you. But if there's one more friend who has already watched it, now whether he has a test or he has a party or he is getting married, doesn't matter to you. He has watched the movie. You will not, it's gone. You will not make any plans with him. Right? So a relevant cost or when things are relevant is when it is something that is a future event. If it is a sunk event, then it is automatically no longer relevant. It is gone, end of story. Okay. right? So I hope all of you are clear with what is relevant cost. We will look at an example shortly. I know it's a little bit too much of theory so far, but I'll explain to you the other examples of relevant cost. The second example of relevant cost is incremental cost. What do I mean by incremental cost? This is a cost that will increment. Increment means what? Increase. Depending on your decision. So if you decide to do a project, the cost will increase because of the project. So if there is a cost that is increasing because of a certain decision, that is an incremental cost. And only cash based costs are relevant. Because as I told you, we are only looking at cash when we are looking at investment appraisals. And for the same reason, while doing investment appraisal, cash is a better measure, remember, and not profits. So we are only looking at cash. We are not looking at other costs that are not cash based because we've already explained that, right? We've already seen it earlier here. We are only bothered about cash and cash expenses. We are not bothered about non-cash expenses. So non-cash expense like depreciation will not be a relevant cost for us. Because again, I said in the previous slide that cash is a better measure for investment appraisal. So obviously, non-cash items, even non-cash expenses will not be relevant to us while doing investment appraisal. Remember, while doing investment appraisal, cash is the better measure. We've seen that in the earlier slide. Non-cash items will not be relevant to us while doing investment appraisal because we are only sticking to cash items. Okay. With which, again, I will not explain opportunity cost now because I feel it's too much theory, and I don't want to like dry up your mind. Let's look at, we will come back to opportunity cost, Nitesh. Let's look at test your understanding 3. So today we've seen what? We've seen accounting profits and cash flows. And now we're looking at relevant costs and we're looking at test your understanding 3. Right? What does test your understanding 3 say? A manufacturing company is considering the production of a new type of item. Each product, each widget will take 2 hours to make. Fixed overheads are apportioned on the basis of $1 per labor. If the new widgets are produced, the company will have to employ an additional supervisor at a salary of $15,000 per annum. The company will produce 10,000 widgets per annum. What is the relevant cash flow? So think about it. What do you think would be the again? What we have to do is simply take what we need. Make your life easy. Look at the numbers. See if a certain item is relevant. See if a certain item is not relevant. Each widget will take 2 hours to make. Fixed overheads are apportioned on the basis of $1 per labor hour. So basically, each item. Fixed overheads, Yashika, yes. Fixed costs here is not an incremental cost. Where is it? Fixed expense is a committed cost. I mean, even if you have to pay it now, right? So fixed cost is you've already committed it. It's fixed. You, for example, your landlord, he has already asked you a rent of $1. And obviously, whether you make the widget or you don't make it, you have to pay him the rent. It doesn't matter to him if you are making 10 widgets, 100 widgets, 2000 widgets, or nothing. Maybe you are sleeping in the office. Right? So it doesn't matter. It's gone. It's not gone, but it will be gone. The new widgets are produced. The company will have to employ an additional supervisor of 15,000. So what do you people feel is the answer? Test your understanding 3. 15,000 is the relevant cost. Why is 15,000 the relevant cost? Because again, remember, what is a relevant cost? It is a cost that is affected by the decision you have made. If you make the widget, you will hire the supervisor. If you don't make the widget, no need to hire the supervisor. So 15,000 is the relevant cost. But what about this $1? It is fixed. It is not affected by the decision you are making. See, this is a cost that is not affected. Whether you make the widget or you don't make the widget, there is a fixed cost of $1. So it is irrelevant. No matter what you decide, Anjana, yes. So it is irrelevant. Therefore, the answer to test your understanding 3 is 15,000. Again, I'm still seeing people are still joining. I hope you are able to catch up. If you can't, if you are missing out on something, make sure you watch the recording. Right? So I hope all of you are happy with test your understanding 3. Is it clear? Just let me know. Yes. Okay. A company is evaluating, it says an additional question, a proposed expenditure on an item of equipment that would cost 160,000. A technical feasibility study has been carried out by consultant at a cost of 15,000 into benefits from investing in the equipment. It has been estimated that the equipment would have a life of 4 years and annual profits would be 8,000 after deducting annual depreciation and annual charge of 25,000 for a share of the existing fixed cost to the company. I have a reason to say that the answer to this is 160,000. Relevant cash flow, I have a reason. I haven't fully, but I haven't fully, given it a full thought, but I feel the answer has to be 160.
It's 3 o'clock.
Let's check this, okay? After the chapter summary. 15,000. 160,000. Estimated profit. Okay. There is one thing I've missed. See, yes, it has what? It has a cost of 160,000. Okay. This is a future expense. But what about this 15,000? I don't recollect exactly what the textbook was saying, but this 15,000, see, a technical feasible study has been carried out. Has been carried out in English means it is over. Has been, English, in basic English, has been carried out means it's already done. Will be carried out means future. Has been carried out means already paid. So 15,000 is sunk. Let's see if the textbook mentions on that. 15,000 is a sunk cost, right? It is already paid. It is already gone, right? So that is why that 15,000 we will not take. Now, the relevant cash flow is 160,000, which is a future expense. Very good. It has been estimated that the equipment would have a life of 4 years and annual profits would be 8,000 after deducting annual depreciation of 40,000. Okay. And an annual charge of 25,000 for a share of existing fixed cost of the company. So again, think about it. Annual yearly profits are 8,000. And we've deducted annual depreciation of 40,000. So again, if you see, your estimated profit is 8,000. Yes. And obviously you deducted, again, I will put it in a different format from the textbook. But it's like saying that you have a profit of 8,000 and obviously you will get profit after deducting the expense. See here, you'll get profit after deducting the expense. So expense is a depreciation of 40,000 and the question only wants to know what is the cash flow, not the profit. Right? And as I told you in this chapter, when you do investment appraisal, your decisions will be based on what cash you have, not based on profit. So you want to know what is the cash that you have. Are you understanding? So we add this back and we say maybe the cash would have been, if think about it, from whatever cash that we have, if the expense was deducted 48,000 to get a profit of 8,000, the cash should have been 48,000. So we're trying to arrive back, we're trying to work backwards and find out what cash we have. Right? And again, the inflow, again, fixed cost is not going to be relevant. Right? But again, I just want to know what was the cash flow, what cash did I get? So for that reason, I'm adding back that also to just know what was the cash inflow. So 248,000, if I add 25,000, the cash inflow was 73,000. And the outflow of cash was, we've seen it earlier, 160,000. Okay. That is it. Again, we just want to know the cash inflow and the cash outflow. We're not worried about profit. We're not worried about expenses. We just want to know what is the cash that is going out and what is the cash that is coming in. The cash that is going out is 160,000. It is relevant. Right? And the cash that we are getting, the cash inflow, is 73,000. Now there is a little bit of a future topic that you have to understand in order to understand this perfectly. But as of now, for this level, let me simplify it. Basically, you need to understand why 15,000 is not a relevant cash flow and 160 is a relevant cash flow. Okay. Now we will look at what we will look at payback. Again, for those of you who have attended the demo, you know that payback is something that I have covered in the demo. But even if you have not, no problem. I will quickly recap on what payback is. Payback period. What is payback period? Okay. Again, I am giving you, say, I am putting 10,000 rupees to do ACCA, for example. Right? Now you have invested this money, so I'm sure you want this money to be paid back to you by somebody because you're making an investment, you're making a big investment, right? After doing ACCA, suppose you get a job that pays you, say, 2,500, for example. Now you invested 10,000 rupees, you took 10,000 rupees from your parents, and now you're getting 2,500 rupees per month. So, how many months will it take to earn back for you to pay back to your parents? 4 months. So, 4 months is your payback period. So, payback period is basically the period of time a project takes to pay back the investment amount. That's it. Right? Now, again, you people, what about others? What is the right answer? How many months will it take to pay back? I'll make another example. I am giving you 5 rupees. Or rather, you are giving me 5 minutes. And every year, I will return 1 rupee. How many years will it take me to pay you back? What everybody needs to type? 5. Right? Guys, again, please, this is something that we will take only 2 minutes. After this, whatever we are doing is new things. So don't think, oh, everything is from the demo. Only 2 minutes it will take for me to finish the demo part. After that, it'll all be new things again. Right? So 5 years. So what did you do? The initial amount of 5 rupees divided by the yearly return that I'm giving you. And that gives birth to this formula. What did I do? Initial investment, you invested 5 rupees, and yearly I paid you 1 rupee. So that is where this formula comes from. Formula is initial investment divided by the annual cash flow. Again, now this is something that is very basic, so I don't want to like take too much time explaining this because remember we have to finish the syllabus also, right? So again, let's look at test your understanding 4. Test your understanding 4 is something that I want you to look at on your own, right? How many of you think you can answer test your understanding 4? You're investing 2 million and every year you will get 50 lakh, 500,000. So how much is the payback period? Very good, Yashika. Everybody respond. So again, I don't think I need to spend time in this specific question. Very good. Let's look at test your understanding 5. A project involves spending 1.8 million now, and annual cash flows from the project would be 350,000. Very good, Nitesh. But 1.1. Open calculator. Siri, open calculator. Okay, not in the mood. So, again, guys, what we have is 1,800,000 divided by 350,000. Put it on your calculator. Divided by 350,000 is 5.1 years. 5.1 years. Now, again, some people automatically, again, this is the right answer. This is the correct answer. But some people automatically assume that 5.1 year means 5 year and 1 month. Please don't get yourself mistaken. 0.1 year, it cannot be 1 month. Right? 0.1 year cannot be 1 month, because in a year there are 12 months. Are you understanding? In a year there are 12 months. So we'll have to do some basic calculation, which isn't very difficult. Right? How will you annualize it? 0.1 year. I don't remember what was the exact figure. 1 million. 350,000. It's 0.428 something. So if that is converted to a year, 0.1428 something it was. Okay. That you will convert to a year. So what Nitesh says is, so the approximate, yes, Nitesh. So it will again 5, test your understanding 5 if we're looking at. So we've covered quite a lot of test your understandings. So you see, this is exactly what we looked at. We got the answer as 5.14, I told you, no, 5.1428. So this is exactly right. But remember, 0.148 does not mean 148 months. You have to annualize it by multiplying it with 12. So which is 1.7 months. So you can say the payback period is 5 years and 2 months. Or you can say 5 years and 1.7 months to be precise. Right? So anytime anybody is deciding to do an investment, you need to ask them, what is the payback in this investment? If any people are deciding to buy an asset, say a property or something they've decided to invest, you will question them. What is the payback period? How much are you investing and what kind of profits are you expecting? What kind of annual cash flows are you expecting every year? So you have to take the payback period from them. This is what payback period is talking about. Okay, so I hope test your understanding 5 is also comfortable to everybody. Now comes test your understanding 6 before we go for the break. What does test your understanding say is there is a specific project where I have invested, see, 0, time 0 means now. 0 means now. Okay. 1 means next year, after 1 year. I hope that is clear. 2 is after 2 years. So right now there is minus 1,900, meaning that right now I'm investing 1.9 million. And the problem is every year I'm getting different amount, which is most likely the case in real life. When you're doing business, you may not get the exactly same amount every year. Maybe 1 year you'll get 1 million, 1 year you'll get 1.2 million, 1 year you'll get 800,000, 1 year you'll get 2 million. You may not get the exactly same amount every year. So most likely your cash flows will be uneven. See here, all the cash flows are uneven. See, all cash flows are uneven. It's not evenly received. So in this case, the question becomes a little more challenging. Second, so you cannot implement this formula because for that you need one annual cash flow, and here the annual cash flows are different. So there will be a little bit of more calculation. Third year, you get 600,000. Fourth year, you get 800,000. Fifth year, you get 500,000. So here what you have to do is 1.9 million is invested, right? This is the cash flow. Now what you will do is, basically, again, let me simplify this. It's like you have put 10 rupees invested. Okay, forget that example. Let's look at a simple example. You've put 10 rupees. On day 1, you get 2 rupees. On day 2, you get 3 rupees. On day 3, you get 2 rupees. On day 4, you get 1 rupee. On day 5, you get 3 rupees. On day 6, you get 4 rupees. What is the payback? What you will do is, you will work backwards. What do I mean by work backwards? After 1 year, you've got 2 rupees, yes. Somebody has given me the answer already. After 2 years, on the other hand, totally, in the second year, I'll get 3, yes, but totally, total, in English, total means cumulative. Totally, after 2 years, how much have you received? 5. So after 2 years, you've received a total of 5. After 3 years, you've received a total of 7. After 4 years, you've received a total of 8. And after 5 years, you've received a total of 11. So your answer has to be somewhere between 4 and 5. You will get the, the payback between 4 and in the 4th year, after the 4th year, 4 year and few months. This is what the textbook is saying when it says, where cash flows are uneven, payback is calculated by working out the cumulative cash flow over the life of the project. So here your answer has to be between 8 and 11. Nitesh, clear?
Yes, sir. It's clear.
So if we implement this piece of information in this question now, after 1 year, you're getting 300,000. So it is there in your bank now. You put it in your bank. So 300,000 is there. After 2 years, you're getting additional. So I'm saying cumulative, added up. After second year, you are getting 500,000. And when you put that money in the bank, you have last year's 300,000 already there in the bank, plus this year's 500,000. So you are now having a total cash flow of 800,000. After 3 years, the third year, you're getting 600,000. So you already had how much? 800,000, and the bank was already there. plus you get another 600,000. So how much is it? 800 plus 600, 1.4. So you now have 1.4 million already there in your hand. You have collected it back. And then at the fourth year, already 1.5 million was there in the bank. Plus you got 800,000. So after 4 years, how much do you have? 1.4 plus 800, which is 2.2. So as Nitesh mentioned, the payback period is anywhere between year 3 and year 4. Between 3 and 4. Yes, Niharika. Niharika, I think, has the answer ready. But this somewhere over here is our answer. Between year 3 and year 4. Somewhere over there is our answer. Right? We can break it down further. How will we break it down? I know as a matter of fact that between 3 and 4. So payback period is 3 years and a few months. This I know for sure. How many months is what I have to calculate. How will I do that? Again, after 3 years, you already had 1.4 million. And how much is the excess you need? 500,000. To get 1.9 million, you need 500,000. Right? So what will you do is basically in the fourth year, you're getting 2.2 million. You're getting over a span of 12 months. So how much are you earning in the fourth year per month? 2.2 million you are getting in 1 year. That is in 12 months. So every month in the fourth year, you're getting 183,333. So if you get 183,333, everybody's given me the answer. But again, unfortunately, I will have to calculate. 183,000 you're getting per month. And this is your earning per month in the fourth year. And I want to know how many months it will take me to earn 500,000. Time taken to earn 500,000. One more minute. So see guys, this is my how we is structured. Exactly 3:25. My team has come and told there's a break. So we follow the timings very strictly. Time taken to earn 500,000 is again every month if you're earning 183,000, in how many months will you earn 500,000? Like every month if you earn 2 rupees. Guys, okay, it's almost time. It's 3:24. Right? This much, just make sure you are comfortable with. It's 3 years and a few months. How many months? I'll come back and calculate. I hope you are clear. Your answer is between year 3 and year 4. With that, it's 3:25 p.m. You can take your break, come back sharp by 3:35. Don't leave the meeting. Please stay in the meeting. Yes, guys, let's continue. It's 3:35 p.m. sharp. And our job is to now complete this question and move to the next question. Are you all back? Just let me know in the chat box. Okay. Now, we were looking at this much part of the question we had done. And we said that the answer is between 3 and 4 years, right? But how many months? So we know the answer is 3 years and few months. So after 3 years, you've earned 1.4 million. Now we will calculate how many months. Earning per month in the fourth year. Actually, this I've made a mistake here. It will not be 2 point. The earning in the fourth year is only actually 800,000. 2.2 is cumulative. So the earning in 2000 in the fourth year is 800,000. So 800,000 is the earning per year. So for 12 months, so if the earning is 800,000 for 12 months, the earning per month will be 800,000 divided by 12, which is 66,666.67. 66,666.67. Right? Once we get that, how much do I need to earn in the fourth year to get 1.9 million? I've already earned 1.4. I need to earn another 500,000. So 500,000 if I want to earn, and every month if I'm going to earn 66,666.67, how many months will it take to earn 500,000? Every month I'm earning 66,000. So 500,000 divided by 66,666.67 is 7.49995, which is 7.5 months. So basically the answer is 3 years and 7.5 months. 3 years and 7.5 months. So I think Nitesh's answer was right. 3.8. 3 years and 8 months. So the answer is 3. So you can round it off and say 3 years and 8 months. Okay, so the answer is 3 years and 8 months, with which this is done. Now again, either you can do it this way, or the other way to do it is, in fact, the right way to do it. Was just for me to explain to you the concept. But when you take cumulative, you will take it from now. Right now, our bank balance is minus 1.9 million. I'll remove these figures. This was just for you to understand the concept. Right now, our bank balance is minus 1.9 million because I have invested 1.9 million. After 1 year, when I get 300,000, I'll put it in the bank. So plus 300,000 will come to the bank. So this 1.9 million negative will become negative 1.6 million. It's just simple maths now, guys. 300,000 minus 1.6 million is 300,000 minus 1.9 million is 1.6 million negative. And then we have negative balance of 1.6 million, but on the second year, when we get 500,000, it will become negative 1.6 plus 500,000. Simple calculation on a calculator. It will be negative 1.1 million. So we're basically looking at when are we becoming zero. Again, we are already minus 1.1 million, but in the third year, we get 600,000. So it will become negative 500,000. In the fourth year, we are getting 800,000. So we become, again, simple calculation on the calculator. Minus 500,000 plus 800,000 is positive 300,000. So you know that in the third year, you were negative. In the fourth year, you are positive. So the answer will be between the third and fourth year, which is 3 years and few months. So again, you will say 3 years and few months. Okay. Now, again, you are negative 500,000 in the third year. Right? So you want to see how many months it will take you to earn 500,000 in the fourth year. And in the fourth year, you're earning 800,000. So simple, after this, it's just simple. It is, you're earning 800,000 over 12 months. Either you can do it this way or what Nitesh mentioned. So 800,000 you're earning over 12 months. 100,000 divided by 12, which is again 66,666. Okay. 500,000 divided by 66,666 will be 7.5. So it will be 800,000 is the earning for 12 months. So monthly earning will be 66,666. So if the monthly earning is 66,666, how many months it will take for me to earn 500,000? It is 7.5 months. So guys, that is what test your understanding 5. Is it 5? Yes. No, not 5. 6 says. Is it easy, guys? Anybody, any problems anywhere with test your understanding 6? Anywhere you are stuck? Anywhere there's a problem? All okay? Anybody wants to have a look at it carefully and ask me any doubts? Quickly, any problems? Either you say problems or no problems. Let me know. Quickly, guys. Problem, no problem. NP or P? Which first way are you talking about, Janvi? There's only one way. First way, can you elaborate which one? Others type? First way, are you talking about the part where I said 300,000? This one? Here I put no 300,000. So in the first year, you have 300,000. Others, are you able to hear me clearly, properly? So again, guys, make sure live if you are attending, you have a proper internet connection. Right. Janvi, are you talking about this first way? 300 plus 500 was 800. Are you talking about that? Did you understand the second way? Second way, you understood what is happening? Yes. So that second way is the actual way. First way was just an example to explain how we are kind of adding up, how we are accumulating. Second way is the actual way. So if you understood the second way, good. Second way is clear, no problem. Okay. Now, test your understanding 7 is something I want you people to try on your own. Let's see who gives me the answer first. If you are one of the first people, then your understanding is strong. Try test your understanding 7 and let me know what the answer is. It's there on the screen in front of you. Everyone try. Let's see. I want to see who gives me the answer first. I'm also trying. If I get the answer before you, then it means your understanding is still not good. So obviously the answer has to be 3 years and a few months. How many months? Yashika is the winner. It is 3 years and a few months. I'm just calculating how many months. Everyone do it fast. Again, Janvi, try it. Did you get 3 years and 9.6 months? You all? Was it exactly 3 years, 9.61? Yes. So your answer is right. So test your understanding. So basically, payback is done now. Again, what are the advantages and disadvantages? We need not break our head too much. You just need to know basics. Basics as in concept wise, you need to be clear with advantages and disadvantages of payback. Right? First advantage, it is simple. It is easy to calculate. It will not be 3 years and 11 months. It will be 3 years and 10 months. 3 years and 9.6 months to be precise. You didn't get the answer? Again, look at this. 500. Okay, I'm not quite sure. Let me just check. Again, at 3 years, you know, okay, at the end of first year, you are minus 3,100. Second year, you are minus 2,100. Third year, when you get 900, it will be how much? You are the minus 1,200. Fourth year, you become 1,200 minus 800. You become very good, 800. So third year, you become 800. And fourth year, you become not negative 100, you become positive 100. This is all in bracket, meaning you are minus. 100 is plus. All of this is in bracket. All of this was negative. So you know for sure that your answer is here, coming at 3 years and a few months. Now, that is clear. That part is clear. But in the fourth year, you are earning 500,000 over a span of 12 months. So your monthly earning is 41,667. And Kittu, how much do you need to make in the fourth year to pay back? How much was the balance figure that you need to achieve to get zero? Was how much? 400,000, no? So 400,000 divided by 41,667, which will be 9.6 months. Kittu, where is the problem? You can ask me. Once we finish this, we move to chapter 3. Kittu, any problem anywhere? No. 400 divided by 41,667 will be, why 500,000? 500,000 will be wrong. 500,000 is the earning of the fourth year. You want to know how much, again, you need to cover 400,000. So 400,000 is what you need to earn. Every month you earn 40. Yeah. So is this correct now, Kittu? Clear? Let's move on, guys, to advantages and disadvantages of payback. Advantage, it is simple. It is easy. We hardly took any time. Right? It is simple, most important. And it takes into consideration cash flows. Where look at all these questions. We've talked about cash flows that we are getting. We're not talking about profits. Cash flows, cash flows. Everywhere cash flows. And as we saw in this chapter, cash flow for investment appraisal, cash flow is a better measure. And that is what payback does. It takes into consideration cash flows and not profits. However, the major disadvantage is it ignores the most important one is ignores the timing of the cash flows. It doesn't take into consideration timing of cash flows. And that, I believe, is what we are going to look at in the third chapter. Let me just quickly check. So, guys, as you can see, so see, timing is the next thing that we are going to look at in the third chapter. As you can see, I don't know what is there in the third chapter. I don't know what is the next sum. I don't know what is the next. So, whatever I'm explaining, it is from my understanding of the subject. I don't have anything by heart. I don't know. As and when the topics are coming, I'm explaining. I mean, the ones who are there offline, whenever they were there, you can check with them. I'm not like referring something, no, nothing. So, this is the kind of understanding of the subject you need to master. And if that happens, nobody can stop you from getting a rank. I would like to take this opportunity to tell you that every Friday there will be a test scheduled on the LMS. You can do the test at your convenience, but you have to do the test. Right? And the test will include questions from the textbook and also from the exam kit. And we will upload videos of us solving exam kit questions. So live, obviously, there is classes, and we don't have so much time. We're already in the end of March. We started the batch late because by the time everybody came and joined, there was a little bit of a delay. So for exam kit questions, we will upload videos on the LMS. You watch them and do the test. Every Friday there will be a test. But anyway, this topic brings me to the third topic. It ignores the timing of the cash flows, and it is not looking at, okay, it's looking at how much time the project takes to return money to you. For example, project 1, you invested 50,000. In project 2, you invested 50,000. Project 1, your first year, so let me call it project A and B to avoid confusion. Project A, year 1, it is getting you 10,000. Year 2, it is getting you 10,000. Year 3, it is getting you 10,000. Year 4, it is getting you 10,000. Year 5, it is getting you 10. So this project has a payback period of how many years? Payback is how many years? 5 years. What about project B? Project B, year 1, it's paying you 20,000. Year 2, it's paying you 30,000. Year 4, it's paying you 5,000. Year 4, it is paid. Year 3, it's paying you 5,000. Very good. I'm getting answers. The payback is only 2 years. Right? So which project is more attractive? A or B? But the problem, see, you've said project B is more attractive. But the project is in year 6, project B is paying 10,000. Project A is paying 10,000, project B is only paying 5,000. In year 7, A is paying 10,000, B is only paying 5,000. In year 8, A is paying 10,000, B is only paying 3,000. So you people, based on your knowledge of payback, said B is better. But overall, which project has better returns? That is this point. It ignores the returns after the payback period. See, project B is only looking at you people immediately. Before I completed the answer, you people said project B is better because it is payback is 2 years. You are not looking at after payback, what is it giving me? So remember, I told you, right? If somebody is investing in a project, you will ask them what is the payback. But remember, payback period is good. Short payback period is good. But after payback, also you need to think. After payback, what are the cash flows that you are getting? But payback period ignores that part of the common sense. Payback period is only looking at how much time a project takes to pay back the initial investment. It is not looking at what will you get after payback. Are you all understanding this point? Everybody? Yes. So with that, chapter 2 has been completed today. And now I'm going to explain to you the third chapter, time value. This is a very interesting chapter. This is, in fact, in FM, my personal favorite. In FM, at least, this is my personal favorite. Although it's a little big, this marks like the beginning to the bigger chapters. And again, I will try to finish it today so that this week we've completed like 5-6 chapters. I have this habit of checking, past. I get excited when I see some topics which I like. So I turn the pages and keep checking what is coming. Lease or buy. EACs. EACs is a very interesting topic. Okay. So I'll try my best to complete at least 5 chapters this week. And simultaneously, we will start uploading on the LMS also the exam kit solving questions so that now itself you start the exam kit.
It's 4 o'clock.
I don't want anybody to start the exam kit in the month of May. If you're starting in the month of May, you're done. I can't help you. Before April starts, I want you people to start the exam kits. Both Kaplan, BPP, Study Hub, practice questions, everything. Not in the month of May. Don't wait for the syllabus to get over, then you will start the kit. For sure, there will be a fail result. Okay, anyway, now we're looking at time value of money. Okay. Can you people see my screen? No, very good. So this is the Taj Mahal, right? Which photo is nice? This photo is nice. Okay. Now, who knows? Now, this is one of, it's a monument. Okay. And it was constructed by one of the emperors, right? How many of you, just GK, how many of you know when was it constructed? Don't Google. Because by the time you think of the answer, I will Google it. When was it constructed? Yes, Shah Jahan. But when? 1600, Kittu says. Don't Google, tell me the correct. Let's see who tells me. Bad with history. It was constructed. Googling. It was constructed in the year 1632. So the construction started in 1632 and went on till 1653. Okay, this place was constructed. Right? And now tell me, how much did it cost to construct the Taj Mahal? So beautiful, so big. Look at this. It's just so nice and big. How much did it cost to construct this? Who knows? Nobody knows. I know. It costed 32 million. That is, I think, 3.2 crore rupees. Don't read anything else. But it costed 3.2 crore rupees to build. Let's close Taj Mahal. Interesting, in 3.2 crore rupees, Shah Jahan was able to construct the Taj Mahal. I will transfer 3.2 crore rupees to you today. Right? I want you today to make Taj Mahal for me in 3.2 crores. Right? I am based in Chennai. Right? So I want you in 3.2 crores to build Taj Mahal for me. Is there any problem? Rashika is saying not possible. One wall, Arisha will make one wall in 3.2 crores. Very good, Kittu. Kittu has sent me a direct message. Very good. 3 crores में 2 BHK ही मिलेगा. That's right. Okay, so 3.2 crores, maybe you'll get, as Kittu says, 2 BHK. I will not be able to make Taj Mahal. Why? Is because in the 1600s, the value of 3.2 crores was very different compared to what it is today. Today, the 3.2 crore rupees in 1600s was equivalent to today's billions of dollars. So the value of money in 1600s, if you went with 3.2 crore rupees in the 1600s, you would be one of the richest people at that time. Because that time 3.2 crores had a very high value. But today in 2025, 3.2 crores has a much lesser value. I mean, you can get a 2 BHK, that's all. You cannot build Taj Mahal today in 3.2 crores. So the value of the money, even though it's the same 3.2 crores, what it can do for you has changed. And it will keep changing. Maybe 10 years down the line, 3.2 crore rupees, you'll not even get 2 BHK. So the value of money, or in fact, money, the value of it changes with time. And that's why time value of money says that the value, point number one, of money, point number two, changes with time. And if you can remember these three numbers, you know what is time value of money forever. The value, point number one, of money, point number two, changes with time, point number three. It doesn't stay the same. For example, if I ask you, forget Taj Mahal, we'll not disturb Shah Jahan now. But suppose I tell you, I'll give you 10,000 rupees. Do you want it today, or do you want it after 4 years? Today. Somebody did not hesitate at all. I don't know who was that. But you want it today, right? Why? Because today 10,000 is more valuable. To you, 10,000 today means today you will invest, today you will buy a maybe not property, maybe you will buy silver, right? I don't know why. I just keep telling people to buy silver. From whatever I have read, silver is going to increase value. So maybe you will buy silver. I buy that, I do that. Every month I try and go and buy one coin, silver coin. I have silver coins. Right? So maybe I'll buy, if I get money today, it is more valuable to me because I go and buy silver. After 4 years, I mean, that's a different value. It has a lesser value for me. So this concept is time value of money. Value of money changes with time. This concept, this is a key concept throughout the FM syllabus. So somebody who does not understand time value of money will struggle throughout FM, especially throughout chapter 3, because chapter 3 is all about how time value of money plays an important role in appraising projects, in deciding, in investment appraisal, basically. Right? And again, people go like, oh, discounting, compounding. I will, in simple words, explain to you what is discounting and compounding, and then we will look at the textbook. Okay? Discounting is, say I tell you that I tell you that you will get say 50 lakhs from a sale of a plot after 5 years. Great, very good, congratulations. 50 lakh rupees you are getting. I have GPay, so if anybody wants to, give me a share of that, please. But you will get this after 5 years. You need to know 50 lakhs you're getting after 5 years. I want to know the value of that 50 lakhs today. So as Yashika mentions, I want to know the value today. I want to know the value presently. I want to know the present value. Right? I want to know the present value, the value of it now. So you have a future value and you are trying to find out the present value, the value today. This is discounting. This process that you implement is discounting basically. You have a future value, you're trying to get the present value. This is discounting. And how this will work in case of investment appraisal is, go back to chapter 2. When I told you that it ignores time value of money, payback ignores time value of money. Look at this. We did all the calculations, correct? After 1 year, we're getting 300,000. After 2 years, we're getting 500,000. After 3 years, we're getting 600,000. After 4 years, we're getting 800. After 5 years, we're getting 500,000. But this 300,000 we are getting after 1 year, not now. The question is, what is the value today? Present value is what? Because I have to decide whether I will invest in Test Your Understanding Project 6 today. I have to decide today, not after 1 year. So I need to know what is the present value of this 300,000, which we ignored in payback, and that was the drawback of payback. What is the present value? This 500,000, very good. Congratulations. I'll get after 2 years. But today, what is the value? We didn't do that. And that is why in this chapter, under the payback period, we said the drawback of payback is it does not take into consideration time value of money. It does not take into consideration time. Right? And that is the problem that the textbook is trying to solve in the third chapter. So everything is connected, guys. Everything is common sense. You don't need to third chapter, second chapter. It's all connected. In the second chapter, you didn't know time value of money is there. You didn't know we have to get the present value, but now you know. This process of the future value, you need to get the present value. That is what is discounting. You see, a future value is given to you. See here, future value is there. You are trying to find the value today, present value. That is discounting. As I said, cash flows will arise at different points of time. Just like in the example I showed you, after 2 years, you're getting 500,000. We need to know the value as per present day. And that is discounting. So I hope everybody knows now what discounting is. So whenever somebody tells you that, okay, you know what, after so much time, I'll give you this much money, immediately you have to discount. You need to know what is the value of that amount today. So you've learned things from, again, like an application point of view, real life point of view. Somebody tells you next year I'll pay you so much. Find out what is the value of that today. And that is what I will teach you in this chapter. How to find out the value of a future amount in today's terms. That is what discounting is. And compounding is the opposite. What do I mean by opposite? You have the present value. You have the present value. And you are expected to find the future value. This is compound. Again, how can I see it? It will be shown here. Yes, future value of present amount. Again, compounding, how does it relate? Compounding calculates the future value, calculates the future or terminal value of a given sum invested today. For example, when does compounding come into use? When is compounding helpful to us? Compounding is helpful to us when you invest today. At a future point of time, if you want to know what is the value of, you want to know what is the value of today's investment after 5 years, that is when you will do compounding. So this is what discounting is. Discounting is in red and compounding is in blue. You can make a note of that. Okay, that is all. Now we continue with an illustration. We will start off. So again, time value of money we looked at. We looked at discounting. What is it? We looked at compounding. So again, in our index, this is there. The next thing that we're going to look at is illustration 1, compounding. An investment of $100, the present value is $100, is made today. What is the value of the investment? After, if the interest rate or the return rate is 10%. How do I do this? Again, common sense. After 2 years, what is the value? So again, remember, now present value is 100. After 1 year, it will be 100 plus 10%, which is 100. 10% of 100 is how much? Do this in your calculator. 10% of 100 is 10. You don't need to do it in your calculator. So after 1 year, it has a value of, yes, Yashika, it's right, 100 into 1 point. After 1 year, it has a value of 110. And after 2 years, see now, this 110 is the new value. 110 plus, again, it will grow by another 10%. 10% of 110 is 11. So 110 plus 11 is 121. So the future value of this $100 after 2 years is 121. That's it. That's it. End of story. Right? Is this illustration clear, guys? What is there on the screen? Ignore everything else. What is there on the screen? Is it clear? Right? So illustration 1 is also over. But now I have a question. Imagine I ask you the value after 25 years. You will sit, it's easy, you understood it, but you'll sit and do it after 3 years. 121 plus 10%, which is going to be 121 plus 12.1, which is 134. I don't know. 34.1. And then 33. Yes. Then again, after 4 years, you'll sit and do it like this. And basically, if you want to calculate what is the value after 25 years, it will take you 25 years to calculate. Which is why, instead of doing it manually like this, we have a formula. Where? Yes, Yashika, you're right. You put your conceptual understanding into the formula. See, we're trying to calculate what? Future value. So let F be the future value. It is the present value, which is 100, P, into, as Yashika mentions, we have to do power of, into 1 plus R. R is the interest rate, raised to N. N would be the number of years. So in this case, it would be 25. So can you tell me what is the value of this $100 after 25 years using this formula, where P is the present value, 100, R is the interest rate of 10%. Again, I'm not able to do it in on my screen, but this would be the formula. Can you put this in the calculator and tell me what is the value of this $100 after 25 years? P into 1 plus R raised to N. N is the number of years. So again, if you simplify, what will happen? Open the bracket. 100 into 1 is 100. 100 into 10% is 1083.47. This 100 in 25 years will become 1083. It's absolutely right. Right? So now, let's look at test your understanding 1. You have 5,000 to invest now for 6 years at an annual interest rate of 5% per annum. What will be, so again, P is 5,000, R is 5%, N is 6. So put that in the formula. P F is equal to P into 1 plus R. R is what? R is 6%, which is 0.06. Raised to, sorry, not 6%, 5%, 0.05. Raised to N. N is 6 here. 6,700. I didn't do the calculation. I'm just going to the test answer and checking. Because it's just basic you just have to enter it in the calculator. There's no common sense, brain, nothing to be used. 6,700 is the answer. So test your understanding 1 has been completed. Okay. Now we've looked at discounting. See, discounting is the opposite of compounding. So the formula can also be the opposite. What is the formula? Just don't look at the textbook. But what is the formula for compounding? Future value is equal to present value into 1 plus R raised to. Now basically, if you have to calculate P, F is given. So what you will do, you will send this, whatever I'm highlighting in red, you will have to send it to the LHS. Simple, going back to grade 5 maths. If you want to know P, just send this to the left hand side. And obviously here on the RHS, it is being multiplied. So if it goes to the LHS, it will be divided and it will become F divided by 1 plus R raised to N is equal to P. So from here it will go. So the formula will be P is equal to F into 1 plus R raised to N. That's it. If you want to further rearrange that, if you want, again, just look at the blue line. If you want to bring this on the numerator side, the sign will change. It will become minus n. So the formula will become f into 1 plus r raised to minus n. And this is known as the discount factor. So what you basically do is, the discount factor is 1 plus r raised to minus n. This is the discount factor. And all you are doing is multiplying the discount factor with the future value to get the present value. So to get the present value, in order to get P, you are simply multiplying F with the discount factor. So P is equal to F into discount factor. That's it. So present value is equal to future value into discount factor. And this is the discount factor. Make a note of this. That's it. So let's do test your understanding 2, discounting a single sum. How will you do this? We need the present value. We don't know. Let it be X. Future value, we need 115,000. N, we know. N is 9 years. R, we know. R is 6%. So all you have to do is, again, rearrange it into the formula. The formula is what? P is equal to F into 1 plus R. R is what? 6% raised to minus 9. F, you know, is 115,000. So you simply rearrange it and get the answer. What answers are we all getting? 68,080. Let me check. Yes, that's absolutely right. Guys, I hope that is okay. Now we're going to look at alternative terms for, again, interest rate or for rate of interest. In the exam and in the question, yes, that's right, Nitish. They might, instead of saying interest rate, they might use the word discount rate, which is the same as interest. They might use the term required return, which is also the percentage, the rate, the interest. Or they might use the term cost of capital, which is also, it's all the same. Whatever term is used, the rate of interest used for discounting reflects the cost of the finance. So they might use rate of interest, they might use discount rate, they might use cost of capital, they might use required return. All of that is the same thing. Okay. So I hope that is clear. Now I'll explain net present value with the help of test your understanding 3. See, the cash flows for a project have been estimated. They've not yet introduced the table. Table will be introduced here. But anyway, I'll directly use the table because in the exam, you can just use the table. Nobody will ask you to not use the table. Here, what is happening is, you see this question is very similar to the question we saw in chapter 2. How much is of 0 right now? How much is the investment? What is the returns in year 1, 2, 3, 4, 5? But this time they want to know what is the present value, right? So what you are going to do is one by one, easily. Here 0, we're investing 25,000. And guys, so this is the time period. This is the cash flow. This is the discount factor. And this is the present value. So I remember I told you future value into discount factor will be the present value. This is the future value. Here, into discount factor, we'll get present value. But remember, guys, this 25,000 is what I paid now. So obviously, if I paid 25,000 now, what is the value of that presently? If I paid 25,000 presently, what is the value of that 25,000 presently? The same. So here, whatever is paid in time 0 now, the present value of that obviously will be the same. So the discount factor here will obviously be 1. So 25,000 into 1 will be the same 25,000. It's just common sense. What I pay now, what is the value of that now? Same. Next, year 1, you're going to get 6,000. But we have to discount. Right? And you know what is the formula. But in order to make your life easier, you know the formula. The formula is here. This is the formula. Basically, you multiply it with into 1 plus r raised to minus that figure, whatever that rate is. But in order to make your life easier, we can just use a table. Again, let me show my screen. So the ACCA itself has made your life easy by giving you a table, and this table is given to you in the exam, where the discount factor you can find it. See, you want the discount factor, it's X. So you can find the discount factor. How? You need two pieces of information. One is the rate and two is the year, first year. So see here it clearly mentions the rate is how much? 6%. Here, 6% is here. After 1 year, here. So if I just scroll, kind of slide my hand over here, the discount rate for 6% after 1 year is 0.943. I'm just not sure. I've just checked this online, but we have to be sure that this table is correct to get the right answer. So I'm just checking at the back. But the discount factor has to be 0.9434, meaning that again, it will be 6,000. The discount factor is 0.9434. So as I said, you will multiply the future value with the discount factor to get the present value. So 6,000 into 0.9434 is how much? Quickly. Again, see, you need the discount factor, right? You need the discount factor. One way of getting it is by doing the formula, where I just mentioned previously. How do you get the discount factor? Again, this is the formula. Future value into discount factor is the present value. This is the discount factor. Either you can multiply this 6,000 into 1 plus r raised to minus n. Either you can sit and do the calculation, or you can use a table where on the table the discount factors are mentioned. Now, example, from this question point of view, it says that the interest rate is 6%. And I want to know what is the discount factor after 1 year. So 6%, 1 year. So R is 6%, N is 1. So I can just use this table. R is 6%. Look at this, 6%. N is 1. So 6% and 1. You can look at the table and get the discount factor. See, 6% for 1. Here will be this figure under 6%, and next to 1 will be the discount factor that we need. Anjana, clear?
Yes, sir.
So it will be 0.9434, and that is what I said. 6,000 is the future value. If you multiply it with 0.9434, what will be the present value? Who can give me the answer first? Is it 5,660.04? Nitesh has got the answer, final answer. Okay. 5660, present value. What about year 2? Year 2, it is 10,000 is the future value. I want the present value. So obviously I need the discount factor, and then I'll use the table. Again, 6% this time for 2 years. So 6% is here. 2 years. Again, I'm putting it in red. Just slide. It will be 0.8900. See this, 0.8900. So the discount factor is 0.8900. So 10,000 into 0.8900 should be 8,900. 8900 into 10,000. 8,900. So the present value is 8,900. What about year 3? Again, future value is 8,000. Discount factor, again, we'll get it from the table. So you don't need to manually calculate. Here it is 0.8396. See here 6% for 3 years is 0.8396. So put that there. 0.8396. How much will it be? 10,000, sorry, 8,000 into 0.8396, 6717. Is it 0.889? Second year? No, it's 0.8900. 6717. Again, I'm just putting what you are telling me. I don't know if I'm not checking the calculation. What about year 4? It's 7,000 into discount factor. How much is the discount factor? Again, 6%, 4 years. So just slide your hand accordingly. 0.7921. Let's see if 792. Yes, Nitesh, that's right. 0.7921. So it will be 0.7921. How much will it be? 7,000 into 0.7921.
5544.7.
5514. Is this correct?
44.7.
It's 5544.7. So these are all the individual present values. But I need the net present value. So the net present value is the sum of, again, net means what? Sum. The net present value is the sum of all the present values. Which will be how much? Again, think about it. Add up everything. Add up all the present values. 566. There's a negative 25,000. So again, just add up all the present values. One 1827. Test your understanding 3. One 1822. Yes, I was right. The net present value of the project is a positive 1,822. Who else got this answer? Yes, Janvi, that's right. 26,816 is the positive. But again, we are also investing, no? The other way to go about it is, just give me 1 second, guys. So it is again, see what you have to do is you are getting 5660 plus 8,900. So some 26,000 you are getting. Okay, 26,816. is what you are getting. But remember, you are also giving what? 25,000. So 1,816. Again, there will be some differences because of the points. Right here, see, they've taken 0.840. I have taken 0.8396, 0.79. So there will be some slight difference because of the points. But the answer is 1,816, roughly. Here, there's 6 rupees extra. That's not a problem. That's because of the point difference. Okay. So the present value of this, in the net present value of this investment is 1,822. So I hope test your understanding 3 is also clear to everybody. Similarly, test your understanding 4 is the same question, but I will allow you to do it on your own. Let's see if you're able to do it, and let's see who gets the fastest answer. You have about 3 minutes. Right? It's the same logic. Again, you can always like Google the discount factor table. Make sure it's the discount factor table and not the annuity factor table, because that's a different thing, which we will look at in the same chapter. But make sure you have the right thing. If you need any help anywhere, guys, let me know. We have 1 more minute. I know the calculation might take time. Jigyasa, is that the final answer? Okay, 29,760 Jigyasa. Let's see what others say. Okay, so it's 29,000. Let's see. This is test your understanding 4. Yes, 29,760. Again, probably because of the points, you people have slight variation in the answer. That's fine. Okay, with which, guys, again, going back to the time schedule, it's 4:50 sharp. 4:50 means this is the time for our review, which means the class is over. Good news for you. But this 17 things is what we've covered today on 24th of March. So now you have 10 minutes to review, and anybody who has any doubts in any specific area, you can ask. When will the recording be available? Today itself. Janvi is 5, Arisha is 5, Sadia is 5, Prachi, Osama, Yashika, Hassan, Askari. It for chapter 1, 2, 3. Again, Aisha, as I mentioned, because again, by the time the batch started, everybody joined and all that, there was a little bit of a delay. So, what I'm planning to do for the kit is to make, like solve a few questions from the kit, make some videos on the kit, and upload it on the LMS so that you can watch it whenever you want. But for me, right now, top priority is to give you kit practice also, and at the same time ensure that the syllabus is over as well. So what we will do is we will make some content for the kit, solving the kit questions, whether it's chapter 1, 2, 3, and then we will inform you that these chapters questions have been uploaded. Osama is 5. Yes, please. You shouldn't wait. You should start, and we will also help you. As I said, we will also start uploading and all that so that you have some support. You're not left alone, right? So whenever you have, generally people panic when they see the exam kit, but when you have somebody solving the kit, you see it, you have that confidence from day one because generally wherever I have seen, I mean, I have worked with so many institutes, so many training centers before I started this. They all start the kit after the syllabus is over, right? Which I don't want to do. So we will upload now itself from the coming week onwards. We will upload the questions, and you can start watching. This note is available in LMS. Which note are you talking about? The note on which I'm writing. Or are you saying it's not available in there? I didn't get it. Yeah, Nitesh, again, I want to understand. This note is available. Did you mean note?
Yes, sir. I mean, say this notes is available in LMS or not, sir?
These notes
Yes, sir. This
mention
note.
the topic. This we will upload with the video. The video will mention on the in the description of video. It will mention that this is the topic that is covered in this. Basically, like the contents of this video, it will show you.
Okay. Okay. This video is already available in LMS. Yes,
No,
sir.
no, how come? This video is just being recorded. It's we are live, so it's being recorded right now only. After I stop the meeting, then it will get uploaded.
Okay. You write in this note. This note is available in LMS. Yeah, in I write so.
No, you have to take down notes. On the LMS, we will have this is done, this is done. So the contents of each video will be mentioned along with each video. But I want all of you to write, because I know as a matter of fact that if we just share this, nobody will write. And I don't want that to happen. So on the LMS, only this along with the video, it will just say this 17 topics are covered in this video.
Okay, sir.
Yes, as Hitu mentioned, you have to. That's why I'm not sharing any specific. If it is hardly 2 minutes job for me, just convert this into PDF and upload this. But I'm not. I don't want to do that because people will then start watching this like a movie. Notes are there, video is there. No, you have to write notes. You have to sit with calculator. You have to be active. It keeps you awake and alert. So you have to take down lecture notes in class. Anybody is less than 5? I haven't heard from a few people like Hassan, Askari. I didn't hear much from you at all throughout the video. Anjana, okay. Arisha, yes. Janvi was involved. Jigyasa, okay, not bad. Kittu, yes. Nitesh, yes. Sadia, okay. But I didn't hear much from you, but you have given your rating out of 5. Yashika, okay. But Hassan Askari, I didn't hear anything at all. So let me know if you are comfortable. If there's any problem anywhere in these topics. Okay, with that is all. I mean, this topic is over. I think the next class is scheduled when? Wednesday, right? Monday, Wednesday, Friday. Is that your FM schedule? Wednesday, yes. Monday, Wednesday, Friday. Is it Monday, Wednesday, Friday or Monday, Wednesday, Saturday? Yeah, Monday, Wednesday, Friday. Good. Okay. So I will see you on Wednesday then. We will complete the 3rd chapter most likely and move to the 4th chapter. Okay. Thank you so much, guys. You can leave. Bye. Yes, guys. So it is 7:05 p.m. sharp. Yes, Zohirul Islam. See how it works is basically 6:55 to 7:05 every class. There will be a break, and we follow, as I keep saying, we follow these strict rules where we follow the time very properly. Because I know, where I have been with in other places, other institutes. I know on a break, sometimes break goes for 20 minutes also. Sometimes it will extend for 30 minutes. Sometimes the class will end fast. I don't want all that. So that's why I follow the strict timings, that this is the exact time that we will follow. Okay. Now, the next thing we're going to look at, again, as I said, we have to finish the 2nd chapter and move to the next chapter. And today, now in this section of the class, we're going to look at the role of professional bodies. Professional bodies like who? For example, the ACCA is a professional body. Right? Can anybody think of other professional bodies? And let me